Now we're going to bring in Jim Bianco. Now we're going to do it. He is the Bianco Research President. Jim, welcome. Good to have you. You've been listening to the conversation. We've been talking a lot about rising and high rates, highest since 2007 on the 10-year, highest since 2000 for mortgage rates. What's going on here? And talk to us about the dissonance between what's happening in stocks and has happened this year in stocks. There you got NVIDIA tripling so far this year, tripling. And what's been going on with rates?
Yeah, so to start with rates, I think Guy had it right. This is a bear steepener. It just means that long rates are rising faster than short rates. Typically, when that happens, it's the market thinking the Fed's behind the curve. And maybe this is what's happening this time, that even though they've raised rates 500 basis points, we might not be behind this whole inflation thing. And as I like to say, it's not 8, 10% or Zimbabwe inflation. It's more like 3% or 3.5% inflation. And that's wholly unacceptable to the Fed. And if they're not going to fight inflation by raising rates more than one more time, then nobody wants to own their long bonds. And you throw into that the Japanese yields. Japan is the largest foreign owner of treasuries. Their yields are starting to rise for the first time in decades. And all of a sudden, Japanese investors are finding more attractive opportunities at home as opposed to holding U.S. treasuries. And you've got this sell-off going on. Interestingly, if that analysis I just laid out is correct, what stops it? An aggressive Fed. If Jay Powell comes out on Friday and says, we're not done, maybe there's more than one more rate hike, you might then see the bond market start to rally. Now, as far as stocks, they might not like that. They might not like that at all if the Fed says that they're going to be more aggressive, but the bond market would. And there's the rub that these two markets are not going to find the same news, kind of either both bullish or both bearish.
I want to bear down on your point about Japan, if I might. Japanese yields are what right now? They're obviously positive, but they're still very, very low. Do you think they are sufficiently high to cause Japanese investors, who, as you point out rightly, are big holders of U.S. treasuries? Are they sufficiently high, really, to stint the Japanese from putting money into U.S. bonds?
Well, yeah, so the 10-year yield in Japan is around 60, 65 basis points right now, so a little more than 0.5%. But you got to keep in mind that Japanese investors also have to take a currency risk. If they own U.S. bonds, they ultimately need to convert them back into yen. And if they take that currency risk, they then risk losing money on a depreciating currency. They're finding that with all of the volatility and the uncertainty in the yen, they'd rather take 60, 65 basis points and not have to worry about the currency moving 3, 4, 5% against them, as opposed to taking 4.3% in the U.S. Now, this is not happening in big numbers, but it's happening around the edges. And if Japanese interest rates continue higher, you're going to see more and more of it. And markets are anticipatory, and I think that that's one of the things that's concerning them.
Let's cut to the chase. What do you think Powell says on Friday? What do you think the Fed does when they meet later this month?
I actually think he's going to say nothing on Friday. I actually thought that he would actually skip this meeting, but he's obviously not. I mean, Bernanke skipped meetings. Yellen has skipped meetings. He hasn't yet. And I think because they're still in flux. They talk about the end of the cycle, but the market's not acting like they should be at the end of the cycle. At least the long bond is not. And so I don't know where his head is right now. We'll have to see. But I guess I would rephrase what I just said and say I wouldn't be surprised if he winds up saying a whole lot of nothing on Friday.